As discussed in earlier videos, getting your project financing secured is one of the most important part of your commercial real estate development project. Two main necessities that banks are looking for is number one, your facility reaches stabilization, and number two is your venture is generating more income than the amount owed. So how do lenders or banks measure this? This is called debt service coverage ratio, DSCR. The formula that is used to calculate this is the net operating income divided by the total debt service. So what the bank is looking for is your DSCR needs to be more than 1.0, which in simpler terms basically means your net operating income has to be more than the total debt service. Majority of banks and lenders are looking for DSCR that is 1.25 or better. Why that's important is because it will help you in securing your loan, and it will also assist you in getting a better interest rate. Now we'll go over an example that you can see on this split screen right beside me. Is you have a business that's generating a net operating income of 100,000, and you have total amount of debt that's 85,000. So if you divide 100,000 by 85,000, you have 1.17. There are a few other things that banks or lenders look for. One of them that is very important in securing your loan is your business to be generating positive cash flow. One of the other ways that banks or lenders assess you as a borrower is the value of your property needs to be greater than the cost of construction. Some of the ways that a bank evaluates that is, of course, your property location, property similar in the area, and then the cost of repair. Lenders primarily define value as the total amount of income divided by the rate of return in operating your facility. This is another important formula that banks use in assessing for your loan. Next, we'll look into how construction loan interest rates are determined. They are usually fluctuated by market interest rate, which is typically determined by prime rate and LIBOR rate. A fair interest rate is typically the prime rate plus 1 to 2%. When planning for a project or looking to get a loan secured, it is very essential to assess the total amount of costs that occurs for your project. There are four major costs that we'll go into. The first major cost you're gonna have is the hard cost. The hard cost typically entails your construction cost, your FF&E cost, and every material that is used on your project. So all that together is going to be put into the hard cost. Number two, you have the land cost. Land cost is the total amount spent to acquire your land. This sometimes falls under the soft cost as well. Number three is called soft cost. Soft cost is typically your engineering fees, your architectural design fees, your permitting fees. You have your third-party inspection fees, your broker commission. So all the miscellaneous costs that occurs is typically falls under the soft costs. Number four, which is often overlooked, is called contingency reserves. Now this is very important and is overlooked a lot. I've seen it happen, is basically having that contingency funds available to make your payments, interest payments, and making sure your loan is solvent. Lenders typically will ask you to keep about 5% of your soft costs in reserves. It is essential for you to consider all these costs before applying for a loan. It is very important because it is going to be used from banks in assessing your loan, and it is very important because if you don't have all these costs allocated, you may not be able to complete your project. In this video, we addressed everything that the bank or lender wants to see from you. In the next video, we'll be diving into what you can do as a borrower to ensure you get your financing secured. Like or subscribe to our channel. Thank you guys for watching.